Every act of industrial production carries an invisible cost. When we measure the total economic output of a nation, we typically rely on gross domestic product, or GDP, and gross national product, or GNP. These figures track the total market value of everything a country creates. But these gross metrics contain a structural blind spot. They tally the value of the final goods produced, but they entirely ignore the physical capital that was ground down, worn out, or destroyed to create them. To find a more accurate economic reality, we look to net domestic product, or NDP, and net national product, or NNP. These metrics are calculated by subtracting the value of that consumed capital from the gross totals. To understand the sustainable wealth generation of an economy, we have to look past the top-line gross production and calculate the net reality by measuring exact wear and tear. We can isolate the mathematics of this transition from gross to net by looking at a simple agricultural cycle. Consider a farmer who begins a planting season by consuming 10 rupees worth of wheat seeds as their initial input. At the end of the planting season, the resulting harvest yields 100 rupees worth of mature wheat. In this scenario, the gross produce is strictly that final 100 rupee value. It represents the total scale of the output without any deductions. Looking at this mathematical breakdown, to find the net produce, we must subtract the 10 rupee input cost from the 100 rupee gross harvest. This leaves us with a true value addition of 90 rupees. Gross output maps the total scale of activity. Net output maps the actual wealth added to the system after accounting for the resources consumed to get there. While raw materials like seeds are consumed instantly in a single cycle, industrial capital goods degrade slowly over multiple years. Take a manufacturing plant designed to produce tomato ketchup. To operate, the facility requires an initial capital investment, purchasing specialized processing machines with a total market value of 1 crore rupees. This timeline tracks physical wear and tear. Every day these machines run, the heat, friction, and constant motion cause them to lose structural integrity and operating efficiency. Eventually, the equipment reaches a point where it is entirely obsolete. It becomes scrap metal, and its functional economic value drops to absolute zero. Capital goods are not permanent assets. They are slowly consumed resources, and an economy must mathematically track this steady consumption. In accounting, this is called depreciation. Scaling this concept up reveals a logistical problem. How does a national economy standardize the measurement of this slow degradation across thousands of wildly different industries? Corporations are not permitted to arbitrarily assign lifespans to their machinery for their own accounting purposes. This is strictly regulated by institutional authority. In India, the Ministry of Commerce and Industry legally defines and publicly announces specific annual depreciation rates for every sector. Applying this to our ketchup factory, the ministry sets a firm 30% annual depreciation rate for this food processing machinery. This ledger shows the first year's financial impact. The 1 crore rupee machine officially loses 30 lakhs of value by the financial year's end. Depreciation acts as a strict, legally binding reduction in asset value. It creates a standardized protocol for recording how capital is consumed across the entire national economy. Crucially, this 30 lakh reduction is not cash physically leaving the company's bank account. It is recorded entirely on paper as a non-cash expense. Let's look at a hypothetical financial year where our ketchup factory operates efficiently, generating an actual operating profit of 25 lakhs. This simplified balance sheet reveals the resulting accounting maneuver. Tax law allows the company to subtract the ministry-approved 30 lakh depreciation expense directly from their 25 lakh operating profit. Continuing on this balance sheet, the subtraction results in a final net balance of negative 5 lakhs. Because the company officially reports a 5 lakh loss on paper, they owe exactly 0 corporate income tax to the government, completely legally, despite a year of operational success. At the microeconomic level, depreciation serves as a powerful financial shield. Corporations actively leverage these non-cash expenses to protect their cash flow and minimize their overall tax exposure. Zooming out from a single factory, we have to determine how the government aggregates this slow degradation across the entire national economy. The data harvesting mechanism relies on the income tax department. As corporations file their annual returns to claim these tax shields, the government collects the exact total of claimed depreciation nationwide. If we use a highly simplified model, where our country only produced that single batch of ketchup machines, the gross domestic product is 1 crore, and the total national depreciation is 30 lakhs. These equations represent the definitive macroeconomic standard. Net domestic product equals GDP minus depreciation, and net national product equals GNP minus depreciation. Subtracting this aggregated national depreciation from gross figures is the only mathematical method to arrive at the true net domestic and net national output. There is a strict boundary condition required for accurate national accounting, and it is a crucial distinction for economics examinations. Not all degrading assets in a country are factored into national depreciation. National depreciation strictly isolates capital goods that are actively utilized by businesses for the production of further goods and services. It completely excludes personal consumption. The daily wear and tear on a private citizen's assets does not factor into macroeconomic depreciation calculations at all. If a logistics corporation purchases a smartphone to track shipments, its depreciation is recorded. If an individual purchases the exact same model for personal use, its physical degradation is ignored by the national ledger. NDP and NNP are strict accounting boundaries. They strip away the noise of mere consumption to isolate and measure the sustainable, productive capacity of a nation.